geopolitics shapes oil and oil shapes geopolitics.
Define short-term impacts.
The Strait of Hormuz has never been physically impacted.
We were in a Goldilocks kind of situation.
I would say we were in a better than Goldilocks phase. All the good work that had been done in January and February starts dissipating.
How much you can take and how long you can wait.
You can choose the headlines or you can choose the price.
I don't think we'll get a better time than now to discuss oil and gas.
History rhymes, it doesn't repeat itself. If mankind were to repeat history again, people would go back to still valuing gold.
That's where the math doesn't fit for me, right? Are we actually in denial?
There's a danger in thinking about things deterministically. You have to act, you take some decisions.
Are we giving these arbitrary timelines to ourselves? So Hari, thank you so much for doing this with us. I'll jump right in, right? So before this long stint you've had at Franklin, 17 years now, you were an oil and gas expert, right? So, and I don't think we'll get a better time than now to discuss oil and gas. This is like the perfect time to discuss this sector, right? So, let's get straight to it. What do you think is the real impact on India when crude swings like this? And most importantly, like, what does history teach us?
The history of oil and gas is very long. We go back, it's from almost the 1860s
Correct.
onwards.
Correct.
And so the masterpiece book on that, if anybody wants to read it, is The Prize by Daniel Yergin. It's a fantastic book for anybody wanting to know more about the history of the oil industry and the way it works and the way
it's called The Prize.
The Prize.
Okay.
The Prize. So it stops in 1992, and there's a kind of a quasi-sequel which he's written as well, but The Prize is still the masterpiece on the evolution of the oil industry.
Okay.
In that, I think he mentions somewhere that it's oil is basically the lifeblood of civilization. And that's what I think is the most underappreciated part of the oil industry itself, right? So that's the first part to think about when we are thinking about its impact on what's happening around us. When we think about oil, most of us will think about petrol, diesel. That's just one aspect of it. That's transport. That's one use, transport and logistics. But oil feeds into so much more. It's a part of fertilizers, which means that our food production depends on it. Plastics. The raw material for plastics come from oil and gas. So oil and gas is all around us in transformed ways, and it really forms the lifeblood of our civilization. Now, as an energy source, of course, it is about 30% of global energy mix. And for India as well, it is a key part of our energy mix. India imports about 85% of its crude requirements. We have 15% from our own production. And for us, it's always been a critical part of our energy basket itself. We have been prone to the swings of the oil prices. And what we need to always remember is that the other thing which history has taught us about oil is that geopolitics shapes oil and oil shapes geopolitics.
Explain that. What do you mean?
So the history of many transformations, political transformations in different parts of the world, has been shaped by almost a curse of where oil is available. Unfortunately, we can't choose how it is endowed, but the politics around that has been shaped by the availability of oil and the curses around it. We have, unfortunately, India has not been blessed on that part. So we have been forced to import oil. And what that means is that as oil prices move around, our financial accounts keep moving around as well. Broadly speaking, though, I think the good news for India is that our dependence on oil has been falling. So a simple metric which we look at is how many barrels of oil does it take to produce $1 million of GDP, right? And if you look at the arc over the last 20 years, this was roughly about 1,600 barrels. And that has now fallen
to produce $1 million of GDP.
To produce $1 million of GDP of India.
It used to take about 1,600 barrels.
That's right, about 20 years back.
Okay.
Today, That's down to about 600 to 630.
Okay.
Right? This is dated of 2024.
So dependency has dropped.
Dependency has dropped. What this also means is that when we look at the crude oil prices and we think about oil consumption as a percentage of GDP, right? So that has been falling as well. So I'll just put it this way. 2013 was a rough year for India in terms of oil production.
Correct.
In terms of oil prices,
Correct,
right?
correct.
And
Yes.
the impact of oil on the Indian economy.
Correct.
We saw the rupee fall pretty sharply. We saw current account deficit blow out. It hurt the fiscal arithmetic as well.
Okay. This was the fragile five period.
That's when we were called the fragile five. At that point of time, India's oil expenditure to GDP was close to 8%. In 2024, and to give a context on that, oil prices averaged about $105 to $110 per barrel.
Right.
In 2024, the oil prices averaged about $80 per barrel, and this percentage to GDP was about 4%.
Okay.
Right? So it is at 4%, about 4.2% in 2024. It was 8% in 2013. Effectively, that means that the impact which needs to happen on the Indian finances would imply that the oil prices need to be close to $150 per barrel, like for like.
Right.
So Indian economy has become a lot more elastic. It has become a lot less dependent on oil prices and oil itself. And that is the good news, at least, as we stand today.
Right.
However, it does not mean that it is without an impact. $25 per barrel increase in oil prices will hurt Indian growth by roughly about 50 bips. It hurts inflation by a similar amount, current account deficit by a similar amount. This is according to estimates by the various industry participants. Right?
Right.
So these are impacts which will play out, but even at an $80 to $100 per barrel kind of an oil, it is absorbable. It is beyond that, I think, where the dependency start hurting the economy.
Okay, so at 80 to 100, we're good, is what you're saying.
We were at $80 a barrel in 2024.
Right.
Indian economy grew pretty well.
Hmm.
So yes, we have a recency bias. Among the many biases which we exhibit in our various behaviors, we have a recency bias that yes, the crude oil prices was at $60 a barrel not too long ago. In, I think, January itself, it was at $60 a barrel.
Correct.
From there, it spiked up to about 80 to 90. But in 2024, it averaged $80 a barrel.
Right.
So if we say that, well, the geopolitics which is playing out right now, at the culmination of it, there is an impact which results in a 50% geopolitical premium, which takes it to $90 a barrel. That's not too bad. I think we can still manage the impact of that and still continue to grow well. Yes, there can be short-term impacts, but the economy has shown itself to be resilient enough to manage that kind of a oil
Define
price level.
short-term impacts. Like how do you, what kind of impacts?
So we will see prices needing to adjust. You will see the fiscal math needs to readjust. You will see that the crude oil prices. So at the retail level, prices have not been deflated. It has been absorbed at the government level, right? So the government has raised the duties to take some of the benefits of that increased prices.
Correct.
So the fiscal math needs to adjust down a bit. So either the fiscal deficit expands by about the 50 bips, or the fisc has to take the hit of it. So I think that is the kind of impact which can play. So that leads to impact on spending by government, which can have an impact on GDP growth, or you can have it passed on to the retail prices, and then that has an impact on consumption. One way or the other, this needs to filter through the ecosystem and the economy, and we need to play out. I'll just point out one difference though here. We're just talking about the absolute price levels. But in this environment, what's not hurting is the prices, but the actual availability of those molecules. The Strait of Hormuz has never been physically impacted. Right? So we've never seen that the molecules, the actual molecules, don't make it to the Indian coast. Even in 2008, when the oil prices peaked at $147 a barrel, cargoes were still reaching the country. That cargoes are not reaching the country right now is a true disruption, which is what is impacting the economy right now. For me, therefore, the key binary variable almost that comes about is whether the Strait of Hormuz opens up and when it opens up. I think we think that the base case is still that it does open up with some kind of a geopolitical premium which is embedded in it. And once that those molecules start flowing, then you have the price impact playing through the economy, and then the economy can start to transition to it. But as long as there's an impact of the physical shortage of molecules, that puts us into a bit of an uncharted territory. Now, within that as well, oil and gas play out in different ways. Gas, we're already seeing the shortfall or the shortages of it. Oil we have inventories of that. You can store oil more easily than you can store gas. The amount of storage which you can have in gas is of course less. Gas moves through pipelines much easier. It's costlier to store gas. All of that means that oil has not been a problem so far. Gas is where the shortfall is, and we are heavily dependent on sources upstream of the Strait of Hormuz to meet our gas needs.
Wow, that's a lot of things to unpack, right? But yeah, to sort of put it in a nutshell, you're saying dependency has reduced.
It has.
Right, drastically. The price increase that we're seeing technically is not the problem. The logistical issue that we're seeing around the price increase is the real problem.
It is.
And that's where the real concern is. And as soon as that piece is kind of solved for, we'll see easing. And even if we see easing, even if you're saying, look, on an average, if we land at 80, 85, we should be okay.
Yes.
Right? In a nutshell.
Yes.
Perfect. So you also spoke about slipping on the fiscal math, right? So that leads me to my follow-up question, right? So we were in a Goldilocks kind of situation, right? Almost benign inflation, decent growth, earnings growth was coming back. Even in a election sort of a year, we did slip on the fiscal. So everything was great. It was looking good. The fundamentals were looking good, and this has happened, right? And now it kind of, I don't know if it throws the math out of the window, but it kind of dislodges that entire equation, if I can put it mildly, right? So you think that entire Goldilocks situation has flipped, or you think that this is just a very minor minor speed bump on that math, right? How do you see that play out? Like, do you think this entire narrative that we were building as an industry that we were building, right? And it was not, this was not math that was not there on paper. This was math that was really evident. It was there. And it made a perfect case for an asset class like, let's say, equity. But now, a lot of people, at least that I am talking to, are questioning a lot of that thesis. What do you think about that?
I would say we were in a better than Goldilocks phase.
Yeah.
We were very positive on the construct, the setup heading into January and February.
Correct.
As the outcomes of the Q3 numbers came through and filtered through, what became clear was that this earnings season was pretty good.
Yeah.
It met expectations. Earnings were in aggregate upgraded.
Correct.
The earnings upgrade to downgrade ratio was heading in the right direction. So it looked good.
And it also seemed like the policies of last year seemed to actually be translating and working also.
Absolutely.
Right?
Absolutely.
It was really looking good.
Yes.
Yeah. So from there we've had this issue.
Yeah. So and just to elaborate a bit more on that, it's not just the earnings, it's also the physical indicators as well, right? Yeah. So you had electricity production looking good, showing some signs of pickup, credit growth, a fantastic pickup which you're seeing from 8 to 9% in May to 14-15% in Feb and Jan-Feb. From there, yes, we have hit this particular speed bump. I think this now gets down to a question of how long it really plays out, right? So if it is in the end a more short-lived kind of a problem, right? So say for example, if it's a 6-week kind of an incident or 4 to 6 week kind of incident, so we are already seeing some signs of rapprochement by Trump, by the president of the US. And if that does play out, then we can get back to saying that this is more of a transitory kind of an issue. If we are still facing disruptions, maybe 6 weeks and beyond out, and there are good reasons to talk about 6 weeks, but if you're facing it 6 weeks and beyond, what that means is that you're going to start seeing some of this filter through into the data. Inflation.
You said there's, I just want to stop you there, sorry.
Sure.
You said there's good reason to say 6 weeks. Why?
So we say 6 weeks because we spoke about oil, you know, and how you can store oil. In terms of drawing down on inventories, in terms of managing of the inventories, broadly speaking, and in terms of transmitting of some of the effects from the from the conceptual state that this facilities have been impacted to actually seeing it on the ground level. All of that takes time to filter through.
Correct.
And so that's why we're talking about a 6 week kind of a time frame, where for it to filter through this entire process. So in the 6 week phase, if we're able to get to some kind of a phase where the molecules start flowing. As I said, the more important thing is that the molecules need to be flowing. If we're able to get some kind of a phase where molecules are flowing, albeit at slightly higher, the $80 to $85 kind of a price, then this can be very quickly seen as a transitory kind of phenomenon. People will bake this into the near-term numbers. Yes, Q4 numbers will see some kind of an impact. You have seen production getting impacted. Some auto companies have spoken about disruptions in production. Some gas utilizers, I think in the ceramic companies, have spoken about disruptions to production. But as long as this is short term, you can put this behind you. The market will write off or will look past the near-term impact and start focusing on the future.
Right.
The longer this escalates or the longer this stays in this limbo where you're not getting the molecules, that's when the effects start being seen in a longer term basis. That's when the theory or all the good work that had been done in January and February starts dissipating. We are still right now, I think, in the phase where you can still treat it as deemed transitory in a sense, So to use that phrase which famously was used by the Fed in not a very good way, but we are still in that phase. But as this extends on, that's when you start losing the memory that the economy is in a good phase. But right now, at least our base case is that the molecules start flowing at some time in the near future, and therefore, yes, we take a bit of an impact, but the markets can start focusing again on getting back to the path of growth.
Right. But said and done, when you say getting back on the path of growth, right? A lot of brokerages are now saying 5.9 is a reality on the GDP numbers, right? That's, I think, down from 6.5, if I'm not wrong.
Sure.
So 50-60 basis hit on growth, right? So then in that essence, is it actually transitory? Isn't it 50 bips is a reasonable hit on growth, right? So that's where the math doesn't fit for me, right? My real question here is: are we actually in denial that everything's okay, 6 weeks is there, and are we giving these arbitrary timelines to ourselves?
Sure.
But we're not facing the fact that hit will come, and prepare your portfolios accordingly.
Sure.
Is that the direction that we have to take today?
I think there's a danger in thinking about things deterministically in this.
Right.
In this particular environment. Now, to make these assessments of growth, you need to be a bit deterministic, I'm sure. But as the facts, you need to change your mind in this kind of a situation. So the better way to think about it, as in most things in the market, is to think about it probabilistically.
Okay.
You can make a case, as we did, at the start of it, that this can be a very quick kind of operation which was to be done by US and Israel. But from there, of course, we are facing the fact that this is moving to more of a bit of a complicated scenario where it is not going to be a quick, clean operation which is playing out in the Strait of Hormuz. It is going to be a bit muddled. It is going to be a phase where you are going to have some remnants of this entire operation which has played out. The question, though, is whether, as I said, it gets back to almost a binary outcome. Do the molecules flow at when we need them or not, right? Or are we in a shortage economy? If we are in a shortage economy, then the impact is a lot more severe. If there is, a bit of an impact, as in the oil prices move up, embed a bit of geopolitical risk premium, you have a bit of a slowdown in your economy while you're playing through the current situation. But the question is, how do the markets take it? And if you've learned, one example which we saw was in COVID. We had a big impact on near-term earnings.
Correct.
We had the clear signs that this is going to take time to normalize.
Correct.
But the markets started discounting
it very quickly, yes.
Markets don't like uncertainty.
Yeah.
Once the uncertainty is removed, they start looking at the future.
Correct.
And that's what I'm trying to point to here, right? So we are right now, as we are shooting this right now, we are still in an uncertain phase.
Correct.
So market is discounting all kinds of probabilities. It can, and both can happen. You can have a situation where this does go worse, as you've already spoken, but you can also have it flip on a dime. You can also have a situation where the hostilities are ceased. Some kind of, yesterday there were talks of backroom discussions which are playing out.
Okay.
Now we're not party to what's happening there. But if there are some of those, then we should be prepared to accept the upside as well.
Yeah.
So I'm not surprised to see some of the downgrades happening, but you also need to note that these can change as well. So, which is why it's important to think probabilistically and not pin ourselves to one narrative or the other at this point of time. And so thinking more probabilistically, saying that, we can see these kind of probabilities playing out, adjust yourself and keep yourself, nimble enough to move in this particular environment.
Right. So what you're saying is, as we're shooting this, I think we're in the 4th week of the conflict.
We are in the 4th
week of the conflict.
That's right.
Yeah. So, from what you're saying, 6 weeks is is your deadline, right? So, if we solve things, we have to solve it within 6 weeks. Otherwise, we have a problem. And what you're also saying is earnings hit will happen.
Yes.
And it's more likely or else.
Yes.
Q4. Because it's interesting because this entire thing is happening at the fag end of Q4 and almost at the cusp of the fag end of Q4 and the beginning of Q1.
That's right.
Right? So it might get into Q1 as well.
That's right.
Some bit of it. But if it is contained within that 6-week timeline, that's about it. I don't think the earnings impact will go into Q2 or Q3 after that, right?
Sure.
I'm saying FY 26-27 is what
sure.
I'm saying. Right? Fair enough. So
just to clarify again,
yeah.
6 week is an indicative timeline,
no, fair enough.
which is again an indication of beyond which it starts seeping into the
Correct.
numbers
and
on a more structural
historically,
basis.
how much you've studied this space and historically how you've seen oil
Sure.
and understanding our reserves and all of that, putting all things constant.
Sure,
right?
yes.
Right, fair enough. Said and done, right, with this impact on macro, right, I kind of want to dwell a little deeper on that piece, right. Immediate impact is obviously, whenever we say oil, we have the bigger problem there, which is inflation.
Right.
And with inflation inching up slowly, and it will. And we saw the March print. We already saw a 50 basis rise in the March print. Feb print, and March print will come in, and we're pretty sure that the print will be slightly higher. Of course, it will be in the comfort ranges of the exchequer, of course. And said and done, now rate cuts are out of the window, right? At least from what it looks like. How does one play fixed income now, right? Like, because it's an asset class that is not discussed at all, and primary driver of returns in fixed income has been rate cuts. It's debatable that nothing happened last year despite rate cuts. That's a different story. But said and done, with no rate cuts in sight, how does one play fixed income now? Because if there's going to be some form of uncertainty, fixed income becomes a very important piece of the portfolio, right? So how does one play that?
So we are in an environment where monetary policy, not just in India, but across the world, really has been complicated by what's happening right now.
Correct.
If inflation does spike and oil prices increasing does lead to inflation spiking or increasing meaningfully at least, what this means is that yes, monetary policy, wherever the cutting cycle is on, does get put on a pause. What helps India is two things. Getting into this particular phase, our macroeconomic fundamentals were solid.
Correct.
Inflation was low, arguably
Benign,
too low.
of course, yeah.
Too low, maybe. It was maybe below our
Correct.
nudging on the bottom end of the RBI's comfort range.
Yeah.
So we had room. We have room for it to normalize and get to more meaningful levels. So
Correct.
that headroom, at least, thankfully, we are getting into at a reasonable stage. Second, I think RBI's pace of action last year was very fast, very aggressive, very decisive.
Correct.
They saw a window of opportunity, they seized it. The fact that they were able to take 125 bips means that anyway we were close to the end of the cutting cycle.
Right.
So there was maybe room for 25 bips more if inflation had continued to be low. It's debatable. That was what was being estimated by some market participants at least. Given the current situation, maybe that gets removed from the equation.
But fair enough. But I mean, a counter question to that is that did not get transmitted. At a ground level, it did not get transmitted to that extent. And I think that delay in transmission is somewhat impossible now. I don't know if the transmission could happen now, because if it does, then from my understanding, it's a little bit of a problem, right?
Well, I don't agree with it not being transmitted. So if we look at category by category, it has been transmitted, not to the full extent. Sometime back, we'd done a bit of analysis around this, which showed at least 60-70% transmission for many categories of loans. So there is some amount of transmission which has happened of these loans. What has not happened is maybe at the 10-year GSEC level. But there as well, what we can point out is that the yield curve did steepen.
Correct.
Right? So I think that effect did play out last year, and that was on the fixed income side, at least that was one of the effects which did play out.
Correct.
Now, in this environment, again, we have been short on the duration side.
Okay.
Right? So that is the way we are thinking about it. If fixed income plays a role in the asset allocation should play a role in the,
Correct.
and it's not spoken about enough, but it does play a stabilizing role in the asset allocation mix of any investor.
Right.
It continues to play that role. And there are ways to play the yield curve. As I said, we are more on the short end of it. And that's where we are comfortable right
Comfortable.
now.
Okay. So shorter duration.
That's
the way to go about it. Even in 26, that's the way to go about it.
Things are moving fast, so I don't want to commit to the entire year, but as we are right now, at least, we are here.
Okay. Perfect. So the silver lining in all of this, right?
Sure.
From where we're sitting right now, of course, there's a lot of things happening, but the silver lining across asset classes has, of course, been valuations, right? And it's not just equities. It's strange, but it's not just equities. It's across the board, right? Valuations are genuinely cheap today, at least relatively from where we were 18 months ago, 19 months ago. We are cheap. and the velocity of the fall has made it cheaper
Yes.
to a larger extent. Do you think? I know you don't want to predict, and I know you don't want to get into a conversation like that. But said and done, do you think 2026 will be a year where people in 2030 will look back at 2026 and say, "Damn, I wish I had invested more money in 2026." Do you think 2026 is going to be that kind of a year?
Someone told me recently, and fantastic statement, that you can choose the headlines or you can choose the price. Right? So if the headlines are rosy and favorable, you will not get the price which you want to invest in.
Correct.
And vice versa. If the headlines are tough and grim like they are today, you're getting the prices. So I think that really sums up, what approaches should be, right? So, and history rhymes. It doesn't repeat itself, but it rhymes. Each situation feels different. Each situation where the headlines are not looking good feels unique. It feels like this is something which is unprecedented. And very often it is true that these are unprecedented times which we live in. But I think if we do not choose to take advantage of some of these prices which we are getting, it ends up being a missed opportunity at some point of time. Now the question which will come is that, well, what about, can't the opportunities get better? And they can always, and in grim situations, it can always look like it can get better. So I always think that you have to think about, again, getting back to a probabilistic kind of way of looking at it. So you split up how you want to allocate your money at this point of time. You have certain amount which you put in right now, certain amount which you stagger out, and certain amount which you keep for firepower, as dry powder really. And that gives you a mix of all three. A, you've captured today's price. B, you're capturing the evolution which is happening. And three, if you are not able to invest at all, well, you get the chance to invest it if it's going worse at any point of time. So I think that's a way to approach the markets. But I think, as you've rightly pointed out, the valuations, the prices have gotten much cheaper than they were. Heading into this conflict, we were looking at 15% growth rates coming for the Indian markets in the next couple of years. There was rising conviction about this 15% growth rate.
Correct.
Now, we don't know if this is going to revert to normalcy tomorrow. And we need to account for that probability in our decisions as well. So you have to act. You have to take some decisions today.
Right. So, but countering that a little bit, right? From our side of things, right? Here's what we think. Definitely, we feel 2026 is that year, right? I know you don't like to be deterministic, but from an action point of view, we feel 2026 is that kind of a year. But what we also feel is when we say that, the response that we get, or the conversation that we get is, most of the expectation is what happened in 2020. Right. So there was lower valuations and market fell,
sure.
And hence you put money, and you will see that 25, 30%, 40% very quickly. Right. The expectation is that.
Sure.
Right. I'm not in that boat. At least we are not in that boat. We're saying 2026 will be that year, but it will be a year which kind of moderates your expectation. Right. Even from a long-term point of view, moderate market returns can be expected. At least it's much better than what it was in September. For someone coming in now, expect market plus returns. Right? That's the kind of direction that we can see today.
Sure.
Someone coming in with that kind of pattern, right, where they're seeing that, okay, this happened before, and that's where every dip is being bought, and my outcome is going to be superlative outcome. I don't know if that's going to happen, right? I don't know if this year is that kind of a year. What do you think?
So I'll just point this out that from the start of the year, we are down by maybe about 12-13%.
Correct.
Right?
Correct.
So
time correction plus you had very steep price correction.
Correct.
Yeah.
So what this also means is that even if we are up by about 13-14%, you get back to zero right now.
Correct.
So, which is why the point comes back to, if you take advantage of today, we're not saying that the year is going to be fantastic.
Yeah.
An investor who was still invested at the start of the year will end the year at zero. And from a person who went to sleep in Jan 1st and woke up at the end of the year, and if they are at the same place, they're not going to say that, this has been a great year. But if you're able to take advantage of the prices today, then at least you're capturing some of that movement which is there. Now, whatever your portfolio has, and many investors will be invested right now, they'll be feeling the pain of that 12-13%. But to ensure that some advantage is taken off that dip as well, you need to have some exposure being added right now as well. So now I'm in your boat, right? I mean, the period post-COVID was a spectacular run. And in certain ways, I feel that the Indian markets might have had a fantastic run even if we didn't have, even if that phase didn't play out. So if you go back, what had happened in the year before that was that there were a lot of cleanup actions which had happened.
Okay.
Right? So COVID happened in 2020, but a lot of the cleanup had happened in 2019 towards the end. There was a lot of write-offs of the banking system itself. And that was a key driver of some of the turnaround which happened in the Indian economy. So the Indian economy might have been already primed for a sharp upward movement in the earnings recovery trajectory itself. So from 2019 to 2024, we saw index earnings, Nifty earnings, double. Right? In 25-26, that has fallen to single digits. We're not talking about returning to that double-digit kind of growth path again. And that's a good outcome for the Indian markets. The Indian markets are priced for a double-digit outcome, 12-13%. Let's say about is in earnings on a sustainable basis is doable for the Indian markets. And we're talking about getting to that kind of a trajectory from where we were in September 2024, with the markets we're not yet across that old high itself. Even if we have a decent year from here on, right? If we say markets are up 15% from here, and maybe even slightly more than that, it will still mean that on a 2-year basis, 2.5-year basis, we've not made too much money. So it's now getting to what is your point to determine a great outcome for the investor. But it again gets down to the point that we have been in a 1 year of markets moving sideways. In aggregate, 2 years look like it has not gone anywhere. And if September we have not crossed the old highs, we are looking at 2 years of being wiped out or not going anywhere again. So we've got to take advantage of some of these to accumulate the units. In mutual fund parlance at least, to set ourselves up for whenever the earnings trajectory gets back to the 15% growth rate.
Provided you still have cash left.
That is fair. That's fair, but that's why it's got to be an ongoing basis, right? It's not a. If you've had too much money to invest, also that's been a problem. But it's a part of the asset allocation which you end up doing.
But also adding another caveat to that, it's almost obvious that this is a bad time to stop your investments, bad time to take out money off the table, and sort of change your balance completely. At least we're seeing this kind of phenomena happening in the market. What do you think about that piece, right? Like people taking off money today, right? Panicking, taking off money, and it's natural, it happens. Stopping SIPs, right? Again, natural, it happens because this cycle is a little harsh. And changing their asset allocation completely based on just the headline, right? We're seeing it happen. What do you think? How should one look at it from there?
So there are a couple of ways to look at this. One is that there's an adage that money gets transferred from the patient, from the impulsive to the patient in the markets. That's one way to think about it. Secondly, I think this is, I mean, most investors, I mean, at least in folios terms, are post-COVID now in India.
Correct.
The number of folios doubled and more than that post-COVID. And we have seen one similar kind of a downturn from 2021 to 2023 where the markets went nowhere. And now we are again in that kind of a phase again of the market where September 2024 to now markets have really gone nowhere. These kind of markets also allow you to honestly reflect on what your risk tolerance is.
Correct.
I have heard at least of many investors, new investors in particular, say I have a high risk tolerance.
Mm-hmm.
But I think this really is when you understand
that. Yeah.
You understand this is what it means to have a high risk tolerance. If at this point of time you're saying I'm still going to add, I'm still committed to this.
Mm.
That is high, medium to high risk tolerance. If you are at this point saying that I can't do this, it means that you have a lower medium. At certain point, therefore, you need to adjust your asset allocation. Mm-hmm. You really have to think about that, right? I mean, you need to think about how you approach your asset allocation, because what is worse than having maybe not as high risk tolerance as the returns which you can get, I mean, if you put it that way, is to have a risk or an asset allocation which ends up making you abandon the entire investment policy.
Correct.
So I think this is the time for a bit of reflection. Abandonment is not the strategy. Recalibration of your risk tolerance definitely is. And so I think your advisors can help you and talk you through this entire process which is happening right now. I think that is what you should look to adjust at this point of time. Learn more a bit about.
It's interesting that you say that. It's really interesting that you say that, because this is a phase to really understand how much you can take and how long you can wait.
Correct.
Yeah. So
Correct.
I think once you reflect on that, I think that lesson makes you a better investor.
Absolutely.
Especially in cycles like this. So.
And there are two concepts, right?
Yeah.
One is risk appetite.
Yeah.
And
tolerance by itself.
Tolerance as well, right?
So, and capacity, of course.
Capacity, yes.
Yeah. Makes sense. So Franklin Templeton has been around for 3 decades now, a little more than 3 decades.
3 decades, yeah. We completed 3 decades on February 19th. And so it's a milestone year.
What a 30-year anniversary!
Incredible.
Incredible. Yeah, and you've been around for almost 2 decades with them. And my question really was, how does an investor differentiate signal from noise, right? Because there's so much noise around today, because because of the sheer information that we're accessing today, right? There's so much of information that we're accessing today compared to 10 years back, and naturally, it's almost natural that there is going to be that much noise. How does an investor, especially in today's world, differentiate signal from noise?
Well, as you pointed out, we are completing 30 years in India now. So Franklin Templeton completing 30 years. Some of our funds have been around longer than that.
Correct.
So almost 32 years for some of them.
Globally, you've been there longer.
Yeah,
Much
I mean,
longer.
77 years.
Yeah.
Some of our strategies actually almost date back to that long. I mean,
Yeah.
almost they basically are as old, more than that, from 1947, with same year as our independence year. So,
Wow.
yeah, 78 years completed and maybe heading
Yeah.
on.
Yeah.
So, in India, during this journey, we have been through a lot. I mean, we've seen, Asian crisis, global financial crisis. We've seen the slump in the Indian economy post that, the pickup, the rise, COVID. All of these are events which have happened in this during this particular period. Now, of course, the markets have evolved, the economy has evolved, and we were just having a discussion yesterday, in fact, about where our CIO was talking to us about how it was living through from August 2008 to March 2009, which was a brutal time for the markets. You come in and every day, apparently, the markets were just down, just getting beaten every day. So in that kind of a market where...
And that was a prolonged fall.
It was a prolonged fall,
Yeah.
and if you the thing is, you need to go back and literally live through the headlines of that point of time.
Correct.
we were talking about the Great Depression.
Hmm.
We were echoing that phase of the economics. We were talking about interlinkages of banks and banks collapsing, the entire financial system into meltdown.
Hmm.
At that point of time, how do you think about things? So those experiences are part of our institutional memory.
Hmm.
It gets down in the end about when it comes to separating signal from noise. It gets down to the processes which you have in place.
Hmm.
And the processes are a set of measures which you're taking at any point of time to evaluate what's a good investment. Those stay constant. Understanding the business models, understanding the unit level economics, understanding the cash flows, understanding the potential, the opportunity size of various opportunity sets which are out there in different industries, and how do these interplay with the profitability and the competitive dynamics at any point of time. Some of these stay true. At the helm of these, of course, are managements, right? So your assessment of companies has to be pinned on what you assess to be the management competence as well, and the intention of them to align with shareholders. All of this means that at any point of time, you are looking at opportunities to back the strongest managements, to back the strongest businesses, to back the companies which are likely to emerge from such a situation looking better. If you're lucky, you'll find what Taleb calls anti-fragile companies. Anti-fragile companies are basically ones which benefit from chaos, not just resist or not just survive it, but emerge stronger. If you're lucky, you'll pick up some of those as well. You'll find many of them as well, which are available at discount. So I think it's about tapping into the institutionalized processes which you have at any point of time, and that tells you what is noise and what is signal. It's not easy. I mean, it's easy for me to talk about it this way.
It's interesting that you say that, because we built an internal CRM model,
Right.
where we kind of constantly do that, right? So what we do is, on big days, we document what each one of us are thinking.
Okay.
On big days.
Okay.
Right? So we did that in March, like during this fall. Like, how are we thinking based on news? How are we thinking based on what clients are saying? What is our EQ at that point of time?
Right.
We're documenting this entire thing.
Sure.
We did this in September 24 also.
Right.
When we were at the peak of our
Right.
valuations.
Right.
And we did this in 22 during Russia-Ukraine. We did this during Israel-Palestine. We did this during big days.
Right.
We didn't, it's not that we do it only on big days, but on times when we are seeing that, okay, there's large issues that are there, right? We did this during June of 24, during the elections.
Right.
So we did this during that. So it's nice to go back and sort of see how you were thinking, and very interestingly, most of the reasons that we noted down at that point of time seem meaningless.
Right.
It makes no sense.
Right.
At that point of time, we were thinking so many different things, so much of chaos, and we were there were times when I've written down in 22 on what I was thinking about small caps. Right. On how they might go through a bad phase and all of that. They did phenomenally well in that cycle.
Right.
But we were right about gold.
Sure.
And we were right about silver.
Sure.
So my earliest investor, we allocated silver in 22. Right? So that worked out very well. So we were right about those things. But it's very interesting how this signal emerges, especially when you start documenting these things.
Sure.
So that's what I want to try and understand from you. So what you said was interesting, that to build processes should actually be the first step before you think about a long-term investing thesis itself, right? You have a framework in mind and have very clear guardrails around that, and constantly check these guardrails to see if this is an emotional decision or if it's a rational decision, because you can't be rational. Humans are not, if if you happen to visit our website, our headliner says human mind is not made for investing.
Right.
So
Right.
I'm a big proponent of, the entire team is a big proponent. You know, we're big proponents of behavior.
Right.
Human mind is not made for investing, right? So the only way we can solve for it is through processes. And it's interesting that you say that you know, keep those very stringent guardrails around it, and then, you know, things work out in your favor.
So I think you're right. So for every stock, the equivalent of that is writing the thesis, having a very clear thesis.
Yeah.
Why do you own a particular stock? It has to be
Or a fund.
absolute, or a fund,
Yeah.
right? So you have to know the reason why you're entering a particular stock.
Yeah.
What this also helps is to defeat, as you rightly put, your behavior.
Yeah.
There is an endowment effect, right? Where you value something you own far more than if you didn't own it. Writing your thesis up front helps somewhat in trying to break that. Because if you own something which starts doing not as you had expected,
Yeah.
you can find new reasons to justify owning it.
Correct.
But you've got to be very conscious of that.
Yeah.
And you've got to be able to stress this that, oh, was this why you got into it in the first place? Was this why you still like it? It can change. It can change. But you need to be again consciously saying, well, I thought it was this. This is why I'm owning it. So I think it's about understanding the thesis at any point of time. And I think you've given a fantastic example of how to document that particular journey for every investor as well.
Yeah, so you know, I'll go a little deeper on your strengths as an asset manager, right? So you've been a global asset manager for 70, 80 odd years now, right? And you have a plethora of solutions on your desk for India as well, you know. Do you think we can make a strong case for an emerging markets fund ex-India? Because that's where the action is really happening, right? I mean, you look at your Asian equity fund. I understand the AUMs are small, but said and done, the underlying asset, of course, has reasonable AUM. But said and done, do you think this cycle is shaping up for something like that? Because somehow global capital is not looking at India, right? And they've continued to sell. I mean, I'm just looking at the numbers. It's been like, what, 1 lakh crores now, the kind of selling that we've seen.
More than that.
More
Since September 24, more than that.
Correct.
Much more.
Right. So, these numbers for this year, I think.
Well, this year is about $9 billion, so you're right.
Yeah.
It's getting up to 1 lakh crores.
Correct. So do you think there's a strong case for investors to consider a fund that is ex of India in the emerging market space?
Well, it gets down to what role emerging markets as a category means. And so emerging markets are historically markets which are poised for growth. They have a long runway for growth, and they are well positioned. They have strong macroeconomic fundamentals where they are well positioned to ride a long runway of growth. I think that's been typically what an emerging market has been defined as. India is still very much an emerging market by any metrics in that context. I think what's also important to note is why India is very different from other emerging markets. So if you look at the overall emerging markets basket itself, about more than 80% now is actually Asia. It basically speaks about where the locus of growth has shifted in many ways in terms of emerging markets.
Fair enough.
And within this as well, if you look at the key constituents of the emerging markets, neither said India for now, we'll get back to that. China, South Korea, Taiwan. These are the main markets which are there. South Korea has essentially 2 stocks which account for half the index. Taiwan has 1 stock which is half the index.
Correct.
These are cyclical markets in a sense. They play on the memory, the semiconductor space, and which have been proven to be deeply cyclical. Now, Taiwan in particular, that company has done exceedingly well. It's become very critical for that particular supply chain.
Correct.
And therefore, the market as a whole has done very well.
Someone called it the Strait of Hormuz of AI. Yeah.
But, it is... but these two markets, when we're calling them emerging markets, they are reduced in very large extent to a couple of 2-3 stocks.
Right.
Compare that with India.
Correct.
Right? So you have 10 stocks. If you look at the MSCI India index, you're about 35 to 40% of the top 10 largest stocks.
Right.
Very well diversified. And that reflects the Indian market, right? So Indian markets is not just about one or two ideas. It is large, it is diverse, it is liquid. And I think that's what makes Indian markets stand apart in many ways in the emerging market space. As an investor, therefore, while you may not have... So the problem with those couple of markets, which are pretty large in the emerging market space, is that if that cycle is not in favor, you are negatively exposed. While in India, you can make the case that, you can have periods which are not doing well, but you're not exposed disproportionately to one or two sectors. You have a whole plethora of sectors to look at, a plethora of themes which are interesting and exciting in India as well. And that's why I think India still remains core to the emerging market experience. We are still the fastest growing major economy in the world.
Despite everything that
we're talking about. We're talking about 6.5% falling to 5.9%. Economies would...
I know.
I mean, they would... They're deeply envious.
Yeah.
Deeply envious of 6%.
A lot of people would give anything for that kind of
to
growth.
be able to get 6% growth. So we've gotten to a level where we are dismissing 6%, which is great, because it means our ambitions...
Standards are better.
Yeah. Exactly. Our ambitions are for 8%. And I hope we get there, sustain that. We have the potential to get there. But it's why the Indian market remains critical to the emerging markets experience itself.
Right. So in the 70s, you saw something eerily similar, right? So oil shocks, and then that set the stage for inflation, of course, and then that set the stage for Volcker coming in and increasing interest rates, and of course that started the long bear case for commodities, especially gold, right? So from the 80s till the early 2000s, we saw gold doing nothing.
Right.
There's a similar pattern emerging. Oil shocks. It will affect inflation. Global inflation will get affected. We could see, maybe to not that extent, but we could see rates rising, and we're already seeing gold is falling, and we're giving it reasons like, okay, liquidity crunch, and people selling off, profit booking, $5,000 ceiling, and stuck in Dubai, and all of those reasonings that we're giving. But from an investor point of view, right? How does one look at gold and silver now, right? Because in the recent past, at least, that's become a very, very popular asset class, and the way geopolitics is shaping up, the way the world is shaping up, there is a lot of mistrust, right? And it's almost like this metal was acting as a hedge, and that same metal is now falling, right? For whatever reason. But we've also seen similar patterns in history, right? Do you think we should correlate the two, or do you think that was a different situation, different timeline altogether? Today, let's put the data points in front of us and look at today's timeline in a different fashion.
Sure. So history rhymes; it doesn't repeat. So you've noted the notes which are rhyming in this particular event as well. See, what we know about the current situation on gold is that if you break up, from 2002 to 2022, and sell-side brokerage had done this study where 2002 to 2022, the reasons why gold prices were moving were a set of variables linked to, let's say, interest rates and currencies. Those correlations which bound the movement of gold prices during that period broke down in 2022. So from there, 2022 onwards, a different set of uh, dynamics have been playing out. And in that time also we have seen, of course, the rise of a new set of buyers in the market. So that has meant that gold prices have remained well supported. Now, as I said, this is different from what happened in the 1970s. And to a certain extent, both have one thing in similar. One is, in the early 1970s, we saw the US go off the gold standard itself, right? Which led to, let's say, a bit of questions about the existence of, or the validity of the US dollar itself. We are still going through that kind of a phase again in the global macro scenario, where questions are being raised about the dollar itself, the US dollar itself. The dollar has been weak, and the fundamentals underpinning that weakness in the dollar still continue to be relevant. The US fiscal deficit has been a problem which has been spoken about at length. It's been, of course, now something which we have been speaking about. I remember reading about maybe going back 2011, 2012, when people are talking about how the debt is getting too much. We still are here in 2026 and speaking about how the US debt is too much. And the problem has only become worse in this particular period of time. What has changed again is the weaponization of the dollar in 2022, which meant that central banks have to diversify away from the dollar. So the combination of these two factors means that alternate assets, including gold, continue to be very relevant as an asset class investment. Now, I have always looked at gold as a great intrinsically great asset to own, but mostly as a doomsday kind of a scenario. There was this fantastic study which I read where a couple of chemists went back and looked at the periodic table. And they went and asked a very interesting question. If mankind were to repeat history again, are there any other metals or any other elements in the periodic table which could have ended up serving the purpose which gold does today? Or which gold has served in the history of mankind? And they found none. It means that gold has certain intrinsic qualities which serve as well a doomsday device in a sense, right? So if the monetary system tomorrow were to collapse, right, people would go back to still valuing gold at a certain fundamental level. So that's the underlying basis of owning gold. Many people have pointed out that gold has no cash flows which it generates. It's a lump of metal which sits in a vault.
Yeah.
But I think this is really this is the key purpose which it ends up serving in any portfolio. I get uncomfortable when it is spoken about as an equity class, right? As a compounding growth phenomenon. We are in a peculiar situation where it is doing well because of the dynamics which are playing out. And I think it continues to hold relevance at this particular period of time. So it can continue to do well, and I think it's still got a good role in portfolios. But I don't want to think of, the kind of price move which has happened in the recent past as indication of what it can do in the near future as well. Silver is a proxy play on gold. It's some have called it beta on gold. And I think that's a fair way to look at it. And I think it's maybe a bit overextended in our asset allocation portfolios. We have overweighted gold and underweighted silver. I think that's a fair reflection of where the dynamics stand today.
Perfect. So someone with 10 lakhs today, okay, with 10 lakh rupees to invest, right? How does one build a sensible portfolio? With all that we discussed today, right? Someone with 10 lakh rupees wants to start investing now and wants to understand how to build a sensible portfolio. How does one go about it? And no, I won't take a standard do your asset allocation answer from you, right? Say do standard asset allocation, talk to your distributor, mutual funds are subject to market risk. Let's not listen to that. We'll have that post the video. but how does one build a portfolio today and keeping it as crisp as possible? What do you want to say?
If you want to generate wealth, equities,
Yeah.
and you have no need to touch the money, right? If you have no need to touch the money and you are looking to generate wealth, equities is your asset class.
Perfect.
If you need that money at any point in the middle, then you'll have to split it up.
Okay. Split it up across?
I would keep it broad. So equities, domestic, international, some fixed income, and gold.
That's it. And you don't, and the percentage split will be according to your tolerance. And
Tolerance and we have spoken about we've spoken about the critical role that the current
Correct.
markets are serving in that
Correct.
as well. So,
Correct.
whatever helps you hold on to your investments through this process.
So here's what I get from the entire conversation, right? So all asset classes have got a better starting point today compared to where we were 18 months ago, purely based on headlines, right? And a lot of noise, some bit of actual issues also. Said and done, they're at a good starting point. And if you moderate your expectation, bring it back to ground, you should have a better journey today, especially for someone starting a new portfolio today. From a 5-year, 10-year point of view, they should have a much better journey today than 18 months ago, right? At least that's how I would like to sum it up from all the conversations that we've had today. So I think that's where we'll wrap it up as well. Thank you so much, Hari. This was great. It was great fun having you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.